I do have some investors that are willing to come on board with me. I do know some individuals who have been LPs longer than me. I also walked in those shoes a long time. I want to really make sure I can have a solid performance, perform very strongly regarding asset management.
The Apartment Gurus podcast is brought to you by Greenlight Equity Group, an apartment acquisitions and holdings firm co-founded by Carl York and Tate Siemer, host of this show. We offer you the opportunity to be an owner of cash-flowing, wealth-growing apartments without the headaches of being a landlord. These assets are recession-resistant, risk-mitigated, offer significant tax advantages, and are a great alternative to the stock market. Ready to check it out? Go to www.investwithgreenlight.com today to book a personal consultation with Carl or Tate. Again, that's investwithgreenlight.com. We look forward to meeting you. Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
So Sharon, Brad Sumrock's group since 2015, 9 years learning, working with Brad. Talk about that. Talk about like how that's informed your path and how big a part of that of your business is in business building and getting off the ground and becoming successful in multifamily. How big, what roles that played for you?
Well, it's been huge, Tate, because I will tell you in 2015, we were looking for multifamily. Okay. We were looking for a local mentor. And at that point in time, Brad's business, it's still based in Dallas, Texas.
Yeah.
But it's also living in Dallas, Texas. We didn't want to have to go off on the West Coast with Rod Khalif. We didn't want to have to go East Coast. We didn't want to have to go for Lindale. And we knew that they'd been in the apartment space a long time.
Yeah.
And Brad, we made a connection with Brad and we started investing as passive investors. I have 18 passive investments.
Wow.
Yeah. About half have gone full cycle.
Nice.
Since we started investing in the 2015 space, those are like, as you will know, that's sort of the fat and happy years regarding multifamily.
Right. Yeah.
The environment has changed. There's a lot of fundamentals that people are really having to tighten up on, especially asset management. They're really having to do a really concerted effort in asset management. And then, when we first started, there were some people who had a mixture of the agency loans as well as bridge.
Yeah.
And we made a lot of fine profits with bridge loans.
Oh, yeah. They were wonderful for a while. Yeah.
Bridge loans are going to be the thing that can really take down some operators. Yeah.
They can be. Yeah. Like people that, took bridge 2 years ago, year and a half ago, depending on the bridge, rate cap and term, expiration, or maturity date, if you will. Bridge, can be kind of trouble right now. And there's definitely a sentiment in the LP space. Bridge went from being like the way to do like really kind of rapid forced appreciation plays. Right. And,
yes.
And I'm sure you saw it with as many deals as you've been in, like you get into a deal and there's a 5-year pro forma for, you get to these numbers. And instead of 5 years, it was like 18 months or 24 months to get to your numbers.
One of my first LP deals that went 3 times was a 30-minute period.
So, it was, you say 30 months?
Fire, 30 months.
Yeah.
That was the shortest duration to date. It had a fire, but they executed the business plan wonderfully. They exited sooner.
Yeah.
And it was just a perfect timing. It was just timing regarding that particular property, and that particular sponsor was seasoned. But what I'm seeing more in the 2022 moving forward space, that's where, as an LP, that's where I'm seeing those distribution pauses.
Yeah.
We might as well be candid about that.
Yeah.
I just had an email and got off a phone call with another sponsor before I came on your show, and a capital call. So it's the capital call that I have experienced. And, that's in the 9-year space. And it's all been in this current window. Right.
Right. Yeah. So, so let's dive into that for a sec. First of all, I think for the listeners, the important thing to know about Sharon Riddle here is, she and her husband, 3,500 doors, roughly, something like that. And 3,507 to be specific. And 18 properties, all passive, right?
All passive. We are looking for a GP deal. We've been best and final on a couple, so we've come close. We do have a team that's local here in the DFW area, but we do have some other team members who are outside of Texas. But we do have a concentrated team that do tour the properties. I'm part of that team. One of my other touring partners is a Texas Instrument engineer. Mm-hmm. And so we have an interesting dynamic going on because we kind of flip everything on its head, because I ask a lot of the technical questions and he does what he loves to do, take a lot of pictures so we can kind of dissect what's going on with the property.
Okay. All right. So now are you speaking to your role as an LP or a potential GP right now?
Potential GP.
Okay.
Yeah,
all right.
GP.
I want to come back to the potential GP conversation and kind of get in your head a little bit about what you're thinking there and kind of why you want to go that direction. But for now, I mean, you're a very experienced LP investor, 18 properties over 9 years. And so in some ways you've seen, I won't say you've seen it all because we're all in this like uncharted water right now. And with interest rates quintupling or whatever they've done and starting to stabilize maybe. And, but then, you spoke earlier to the importance of operations right now, which I couldn't agree with you more. Like it's everything: business plan, implementation, and execution, and just, the basics, right? Occupancy and bad debt and, like keeping your expenses down. Those things are so key, especially in situations where you do have a loan maturing and you need to refinance or sell, right? Because that NOI has to be maxed out to do either one of those two things effectively.
Well, to be attractive to a buyer, you've got to have the NOI positioned well, and you've got to have that occupancy really in the 90s. Be frank with that.
So, you're on the Apartment Gurus and 9 years and 18 properties, I'd say qualifies you as an apartment guru, Sharon. So,
Thank you.
Thanks for bringing what you got here to us. I'm going to ask you kind of a real question here. Out of the 18, well, first of all, 15 to you kind of couldn't have gotten in maybe at a better time, right? Like
I know. It was
in terms of the upswing in that cycle. And after 2008, things were super, super flat till like say 11 or 12, like no growth at all in any sense at all. And then, things kind of started to creep up and then accelerate. And then, 15 to 19, well, I say 15 to let's say COVID, things were really looking good. I got in basically 19, 20. And then COVID happened. Everybody thought it could be like doom and gloom. And it turns out like, I think 2022 was like the banner year in multifamily, most volume ever, most price increase ever. I mean, it was just crazy successful year in multifamily during that COVID year. So, and then now we've had this huge correction, if you will, and I'd say perceived distress. I think that's another conversation, but, so, given given that scope of the last 9 years, like out of the 18 deals, like how many have been successful for you?
Well, I have had several. I think I've had at least 4 that have gone at least 3 times.
So what do you mean 3 times?
3 times the principal investment.
Oh, you said 3x equity multiple.
3x multiple.
Yeah.
Exactly.
That's awesome. Yeah. And what was the average time frame on those? 5 years, 3 years?
Well, I told you about the 30-month one. That was kind of the all-time best, but it was like 4 to 5 years.
Okay.
They held pretty close to the 5-year business plan. I will say I've had some that have been longer holds, and typically some of my properties that have been longer holds, I'll be honest with you, they have just not had the multiplier.
Mm-hmm. Okay.
That the shorter term. But part of it, as you well know and understand, it was the time frame.
Okay.
That I came into those. So my expectations, I want to keep really even expectations on the 2022, 2023 properties, because they're not going to perform the same as the 2016. They're just not. Right. So I will be very interested to see what the performance turns out to be.
Yeah. Yeah. So
that I invested in during that time period, because it was post-COVID, and I still am an investor who will invest based on location. Mm-hmm. So I'm really solid on my location.
Yeah.
And a lot of that is holdover for me personally from my single family investor days, because I started in single family investments in 2005. So I did see the 2008, 2009 credit crunch time period in single family investing. And that's why I went, my partner and I went to a boot camp with Alan Cowgill to learn how to work with private lenders.
For the single family space.
Mm-hmm.
Yeah. I mean, in 06, there were the stated loan incomes, and you basically had to sign your name, and the bank would lend you 110% of the purchase or whatever. And maybe the CapEx. And I remember them well. I got into the single family space in 06, and then the crash in 08, and got out for a few years, got back in 11, and single family for the next 7 years, basically. And then had this huge multifamily aha revelation light bulb moment, and have been multifamily ever since. Larger scale, the bigger, the better sort of thing. We've always, my company, Greenlight, we've always been on the GP side, the lead sponsor, finding, on the acquisition side, basically finding deals and putting the deals together with the dollars, and then the operations and all that. So I love having essentially a career passive investor on the show.
I think I can give I can give some different insight.
Mm-hmm. Yeah.
And people who have been in the GP space the entire time.
100%.
And I think that will really be a strength for me moving forward into the GP space, because I think that I will have I may have a different set of investors, because I do have some investors that are willing to come on board with me as a GP.
Cool.
Because I do know some individuals who have been LPs longer than me and even had more assets than me. Not a whole lot, but there's some. And I've walked in those shoes a long time. So I want to really make sure I can have a solid performance and perform very strongly regarding asset management, because in these times you have to, because there's too many factors that will really, as far as the economy, really impact the distribution. Because I've had one sponsor has told me that the distribution is like candy for your investors.
Yeah.
And if you're turning off the candy, then the LP group will get disenchanted very quickly.
For sure.
And I have been on more conversations in the last 2 years with my GPs over distribution pauses and capital calls than I had in the early years. Before, I was just checking in to talk to them because I am a person who is very, very, I do not fail in reading the monthly performance reports. So
yeah,
it really comes from my time when I was a senior business analyst. I read the monthly reports because it's like it really is the financial performance of the property. So I don't fail to do that every month.
Yeah. Yeah. So you're what my buddy Travis Watts would call an actively passive investor, right? I
am an active passive investor.
Yeah. So, Brian Burke has a great book about, it's called The Hands-Off Investor, I believe. And, all about like what it takes to be a very savvy, informed, shrewd, passive investor, right? And passive might even not be the right word. It might be a little bit of a misnomer because you clearly are active in many ways, actually, few kind of key ways. You're in communication all the time. You're reading reports. You're asking questions. So I keep wanting to go into this, the switch to the GP and but I'm going to wait on that because I want to set the stage a little bit better, or at least on the LP side, there's so much to dig into with your level of experience and what you've been through. So circling back to the question, you 18 deals, you've had 3 that have gone 3X. Have you had any that have underperformed? I mean, or let's put it this way, either full cycle underperformed, like came in less than what you thought they would, or that are underperforming now. I mean, you just got off the phone with the capital call.
Yeah, I did. And that's been a property that has been underperforming, but that I will say the sponsor had to come in and he ended up kind of rescuing the property from another sponsor. So very unusual situation.
Okay. So
so he kind of stepped in and took over.
Okay. So painting the picture, you got into the deal under a different sponsorship structure, different sponsor, and that sponsor.
However, I have invested more with the current sponsor.
Okay.
So I've did it all with the previous sponsor.
Yeah.
And with this sponsor, I have been a repeat investor, and I've had at least one property that has gone 3X.
Okay. So you have a good proof of concept track record with the current sponsor who came in. Were they in the sponsor group to begin with at all? Did they enter later? How did that work?
He was in the sponsor group. He kind of got tapped to be the asset manager. And part of the problem is, it's a smaller property. It's in Oklahoma. Oklahoma has really low rent growth. It's just not performing.
We have 4 properties in Oklahoma right now. So
I really wanted that property to make it over the finish line, to at least be sold. It's like, let's just make it over the finish line to be sold.
What's the submarket in Oklahoma on that one?
What's that?
What's the submarket? Where in Oklahoma?
It is Oklahoma City. So.
Yeah. Yep. I know. We know it very, very well. Like I said, we own 4 properties, 3 in Oklahoma City and 1 in Lawton, Oklahoma, right now. So, but yeah, you're right. It's just it's a steady Eddie market. Like you look over, the historicals and kind of performance through downturns and recessions. And, there's a lot of employment diversification there and economic diversification, which makes it, a relatively conservative play on the one hand. On the other hand, when things do, and the economy gets somewhat distressed, it's not gonna keep growing by, 5-8% in rent. You'll be flat or, a couple points up, maybe a couple points down. Are you seeing that? Are you seeing rent lost right now on any of your properties?
No, I'm not seeing that.
Okay.
I will say one lesson that I've certainly learned by going to Oklahoma.
Yeah.
And with some other properties too. Within any community you're in, whether it's like Ray's Masters or, Rod Khalife or Brad Sumrock, I am now careful to be among the first to enter into a submarket because you can't get burned. Because it's unproven for the group. It's unproven within that group. So, yeah.
Okay. So just to clarify, you said I'm not sure I understood you right. So you want to make sure that you're not amongst the first to go in the submarket. So
yes, not among the first, maybe middle of the pack, but not among the first because there's just more risk involved.
Yeah, for sure. So majority of your deals have been in Dallas, Fort Worth, right?
The majority have been in Dallas, Fort Worth. I've had I've actually had a couple in Colorado.
Oh, okay.
In the Denver market.
Yep.
And I've had a couple in Columbus, Ohio market.
Oh, sweet. Speaking my language, now it's our darling market right now.
Oh, it's so nice. Oh yeah.
We love it. We love it. We have I guess six, 7 properties in Columbus, and that's where we're writing all of our LOIs and doing all of our due diligence, and we're all about Columbus 100% right now.
Columbus has some really great things going for it that I could see as a Texan because
it's unbelievable.
It's all, you've got some corporations there. You've got the Ohio State. I have a niece graduated from Ohio State now, and it's a state capital. Yeah.
Yeah. And that's just a start. I mean, that's why we got in 4 years ago into Columbus, was what you just spoke to: the state capital infrastructure, the Ohio State University, as you pointed out, which is the 3rd largest school in the country. And in great affordability, high, satisfaction of living. There's probably a technical term for that, but people just love living there. Massive economic diversification, but you've also got those stable drivers that the government and the university that are arguably very recession resistant, right? They're always going to need to function. And then, 3 years ago now, 2.5 years ago, we had the massive Intel announcement in Columbus, the $20 billion Intel microchip factory that's being built on the northeast suburb of Columbus. Which, does run through real quick: 10,000 new jobs, $20 billion initial investment. And they just announced last week or the week before an additional 8 or 9 billion going into that. They're talking about 4 more phases after this phase 1. And then, so you've got all that direct, injection of, money, right? And job creation. And then you've got, the peripheral economic, kind of what happens, the ripple effect, if you will, or in this case, it's almost a tidal wave effect of bringing in all these other tech companies specifically to be near or next to Intel. And then on the northwest side of Columbus, you've got Honda building a new plant, and you've got Amazon building a huge fulfillment center. So, which are kind of unrelated to Intel, but like what other market in the country has that kind of immediate activity just in the last 3 years? And it's such a massive scale, massive job creation, massive attraction of an industry. And not only, not only the single industry of tech, but like this hugely relevant industry where you've got this global, essentially microchip crisis where 90% of the higher end chips are made in Taiwan. So it's a national security issue, amongst other things. Anyway, I can kind of go on and on about that. But I mean, there's nothing like Columbus, Ohio in my book. I
think it's really awesome too. And I agree with you on all of those, because the rest of the state does not perform the same way Columbus does. It's contrarian to the rest of Ohio. And in many ways, it does really perform a lot like Austin, Texas. However, got that affordability gap that's so much more in your favor in the Columbus area versus Austin.
hit the nail on the head, Sharon. I couldn't agree more. I mean, that is like the one of the key ingredients that of Columbus is the continued affordability there.
Right.
But we've also like got, I think 3 of the last 5 years, double-digit rent growth, something like that. And I heard one of my brokers said they're actually predicting double-digit rent growth for 2024, which again, like, I don't know where else you're going to find that. Maybe there's a few select markets, but so many markets are flat, including some of the really hot markets or historically hot markets of the last 5 years. So whether or not that actually is true, I don't know, and I guess remains to be seen. But just the fact that there's whispering about like that level of rent growth in the economy that we're in, and so yeah, again, I couldn't love Columbus more. I'm from Cincinnati originally, as many listeners will know. I went to Ohio University, and so I have ties close to Columbus, but it was never a place that I spent tons of time before we started looking at deals, buying deals, writing offers on deals. And so, yeah. And I think I think one of the interesting things about this conversation so far, Sharon, and hopefully listeners, you're seeing this, is like Sharon, knows the DFW market. She's been in other markets as well, but like DFW is her bread and butter. Columbus is our bread and butter. And we can both speak with a lot of knowledge and expertise on those markets. And not to mention, I haven't even talked about the resources we have there, the strategic partnerships, the broker relationships, the contractors, the PMs. So picking a sponsor, if you're on the passive side, picking a sponsor that is deeply immersed and vetted in their market, I think is, well, you tell me, Sharon, is that it's got to be a huge part of how you look at things.
It's a huge part. And I ended up going with this particular sponsor. He actually has family in Columbus, Cincinnati area. So he's got a family in Ohio. Dan, my business partner and spouse, he has family in Ohio. They relocated there. Yeah. And so we're able to talk to the sponsor, but also our own family members who could tell us just how marvelous Columbus, Ohio is. Yeah. And so when we went up there and toured the property, I mean, a couple of properties, 2 at one time, we were just, we were in.
Yeah. When did you get into those properties and those deals?
We got into them in the early years, like 2018.
Yeah. So pre-Intel announcement.
It was pre-Intel announcement. So there's still economic drivers are super strong.
Oh yeah.
Or all of that.
Yeah. How are those properties doing? Are you still there? You're still in them, I'm assuming?
We're in one of them. It's 156 unit B class. Mm-hmm. And then the other one sold. Okay. So it's just
did you do well on that one?
Oh yeah. It was one of the 3 times. Yeah.
That's awesome. That's awesome. Good for you. So just to kind of zoom in on what I was getting at before. So, unfortunately, good sponsor aside, right now you have the reality of you're facing a capital call on one of your deals. Actually, let's talk about that specifically for a second. I'm sure listeners, you've heard the term capital call before. To me, it's like it's just a really, if you're in that situation, unfortunately, you've run out of a lot of other options, right? In terms of funding what needs to be funded in the deal, usually operations or paying the tax bill or meeting debt service, any of that stuff. So, maybe talk specifically, Sharon, about what you're seeing in that specific deal. Why is the capital call happening? What are your thoughts on participating in the capital call? I guess, what are your thoughts on it happening in general?
Okay. Well, I have had 2 capital calls within the last 2 years. So let me contrast those. Yeah. With both of them, one of the elements that is the same is they're changing property management companies. Okay. So everything is not running quite as smooth as it could. Yeah. And both of them, they are properties that continue to need some cash infusion. One of my other properties that's had a capital call over in Southwest Fort Worth. So strong location, but they ended up having to switch out their property managers. So to stay on the business plan, you've got to keep on moving forward. So it really kind of gives you some lag on the business plan.
Huge lag, yeah.
Yeah, but with the Oklahoma property, there's never seemed to. It just has not seemed to turn a corner that it could for an 84 unit C-class property. It just, and it's just been a strong asset manager who's been really handling that. But even he is turning around and replacing property manager, and he's going with a local Oklahoma City property manager. So he's switching out a property manager that he uses on the vast majority of his portfolio.
Oh, wow.
And they've been a property manager who they really turn things around. So they're just bringing in a local company to just really turn the property around.
So, okay. So the original property manager, if I heard you correctly, he's using this, this probably a national level, big time, large scale institutional property manager originally that he's switching.
Not necessarily. It's been one who's been in the Dallas Fort Worth area, but he has ended up moving them into properties where he extends his portfolio. Because part of the operation, there's a construction arm, and another part of the operation is a property management arm.
Okay. But regardless, he's got tons of track record, proof of concept with this PM. But what happened here? Like that PM didn't work out at this property to the point of firing them and starting with somebody else. So what happened there?
I don't know the full story. I just got off talking about the disappointment in the capital call, and I thought we'd have an exit strategy, because this property we've had since like the 2015, 2016 timeframe. So it's been a really long hold. It does have an agency loan, so it's got a fixed loan. It's no bridge, but we're on the same page that we're both disappointed in the property and getting it across the finish line.
But clearly it was a management level issue mostly. Would you say?
Mostly. I would say it would have to be for him to pull them out.
So
they had sold another property in the Oklahoma market.
Okay.
So that property was probably performing a little stronger combined with another property. So you had a property portfolio versus a one property. Yeah. And for them to really expand more, it may have made little to no sense for him to keep that property manager in a market where there's a single property to manage.
Okay.
So I think that probably is really more the situation. It just makes economic sense on the labor side.
Okay. So just drilling into the capital call for a second, what's the need? Where's the need on capital coming from? Is it debt service? Is it just operational? Is it,
it's operational. Yeah.
Okay. And is that a result of collections, occupancy, all of the above?
It seems to be a combination.
I know I'm asking a lot of operational questions that, I
read my monthly reports.
And as a passive, like you only have a limited view into a lot of this stuff, right? Like you basically are going off of what's reported to you and what the sponsor will tell you. So, but I guess, so did you get deep enough in this call? First of all, was this the first you had heard of it? Was this call today?
It was, and they had a unique situation where they didn't have to have a full vote of the passive investors to initiate a capital call.
Oh, okay.
So that was something that was unique in the paperwork that was drawn up. And normally the sponsor does have Gene Trowbridge do all of his paperwork as far as the legal side, but the previous sponsor had done that with a local Oklahoma City attorney.
Gene's great. Gene's been on the show. It's been a long time, but love awesome. Gene. Yeah. Gene's somebody that I think we talked about this. He just loves what he does. Right. He's an older gentleman. I don't think he'd mind me saying that, but given just tons of experience, and got into the legal side late in his career, in his late 50s or 60s or something like that. Anyway, so I guess just so I understand a little better, what is that? What do you mean in the paperwork? You mentioned the full boat. What is that referring to?
Well, just really more the operating agreement.
Well, okay. So when you said that they didn't have to have a full boat of investors to do the capital call. I didn't.
It was just kind of an unusual. It was just the legal paperwork was just written up a little unusually that way, because normally that is not the case. Normally they have to have some vote. What I've experienced with the other capital call, thank goodness I've only had two. I really only wanted to have one, but so you need to. Those are things that you do need to kind of look over, passive investors, when you're going over all of this private placement memorandum.
Yeah.
So look over all of it and just kind of see, what are they telling you? If things are working well, how do they operate? If things are not performing to the business plan, what's the off ramp? What's their strategy?
Yeah. Here's a pro tip for you listeners. ChatGPT is one of the best legal assistants that we've ever had access to for free. In a matter of minutes, you can cut and paste a full legal contract into ChatGPT with some good prompts. You can get some really interesting high level feedback just to start with. And of course, doesn't necessarily replace an attorney. And the need for, because PPMs, private placement memorandums, and operating agreements are not simple, easy to understand documents. They're legal docs and there are nuances, and you miss one line and all of a sudden the implications are, can be huge. So, but
we always, my partner and I always read our PPMs.
Yeah.
So, but you made a great point, Tate. You could have just one line, and it can really change some scenarios.
Yeah. And again, I won't deep dive into the AI thing because it's easy for me to do right now. But, a lawyer can miss one line too, right? The chances of ChatGPT 4 and then, soon to be 5 missing something key that you need to be concerned about, even if it's one line, or in my opinion, are fairly slim. And, it's not like you want to put that to the test necessarily, but I think it's an incredibly useful tool. And I've had some legal docs that I got amazing results out of ChatGPT in a matter of 5 minutes, cutting and pasting and writing a really good prompt. So side note there, a little pro tip for you guys. Okay, Sharon. So I guess going back to just to kind of circle up fully on this capital call issue, what are your plans? Obviously you just learned about it. But I guess let's put it this way. First of all, what are their plans? They're asking for whatever, few million, $500,000, whatever they're asking for out of the capital call, or trying to get to in the capital call. How are they going to apply that in a business plan sense? And kind of what promises does that provide you if the capital call is successful? Did you get that far with them?
Yes, they are going to be using those funds operationally. Mm-hmm. So they're going to be utilizing those with the new property manager for some make readies.
Oh, okay. So CapEx.
It's CapEx. It really is
Got it.
CapEx.
Got it.
And they have infused 1.4 million in between a couple. So it's not like they've just been sitting on the sidelines. They've been actually cash infusing this 84 unit property.
Yeah. So 1.4 million from the GP has been injected.
It has.
I mean, that's huge. That's
huge. It is huge.
Right. And I guarantee, my guess is I could almost guarantee there's nothing in the PPM or OA that would have required them to do that is my guess. Right. No, so they've gone to huge, great lengths on their own, brought their own resources to try to fix this, and they still need money. I'd love to know kind of exactly how things fell apart, because things fell apart to a really huge degree there, obviously, to get to where they are.
Yeah, well, I would like to hear some more.
I'm sure you would. Yeah.
Yeah. I always want to hear more. And I do have one of the partners, I have their cell phone. So I just call them because I've been an investor for so long.
Yeah.
And I do have that kind of relationship with my sponsors. I can call them now. Yeah. I've had in Florida where the close was not as clean as I would have preferred. And it got a little more antagonistic. I was not being antagonistic on my side. I was asking probing questions. Sure. And I was just causing the temperature of one of the sponsors to rise a little bit more. And I just don't think that he was as unflappable could have been. And you can have those situations. And I will say for passive investors, do not be discouraged, because you should have open communication lines with your sponsors, whether they communicate with you or not. And I have had a sponsor that, was explaining how a property was going on a video. It wasn't a webinar. Yeah. And I called him out, and he had his phone number on there. So I called him, like, why not have a webinar? But I said, it's like you're just in a movie screen. Yeah. You're behind the movie screen, and you're reluctant to communicate with your passive investors. Yeah. I think he was just more enamored with the technology of doing that. Yeah. He's an engineer. Then thinking about, well, how did that come off with passive investors, especially a collection of passive investors who are more experienced. It's not their first time to do it. Right. You need to really have those conversations in a webinar. Yeah. Yeah. All right. Well, I want to shift gears here to the GP transition that you're looking at making in a second. But before we do that, I think, speaking to all the passive investors out there, potential passive investors out there. And by the way, to me, and I've said this for the entire time we've been in multifamily. I think, and I'd be curious your thoughts here, Sharon. I think that the LP spot in these deals is the sweet spot, right? Like, in my opinion, what we all kind of want to be LPs when we grow up in one form or another, whether we're continuing to be on the GP side as well, or being a fund manager, whatever that looks like. The LPs, they get usually a significant amount more equity in the deal than the GP team. They're getting paid first, ideally, with a preferred payment, and they're certainly getting paid first when it comes time for a capital event. And their pref is caught up if it can be, and then they get their profit share on top of that. So they've got security, they've got, preference on payment. The only role they're playing is essentially, reading docs, signing docs, and deploying capital. Right. So, to me, it's the sweet spot. It's like, why wouldn't you want to be there? If you've got the means to be there, and especially if you got the knowledge and the track record that you do, which, kind of goes back to the Sunrock investment that you've made and the education you've given yourself. But, so I guess, kind of high level, maybe
I'm going to put you on the spot here a little bit, but for the interested passive investor or even the active passive investor now getting started or somewhere in the early parts of their business, what maybe top 3 things, like kind of maybe a little outside the box, should they be considering, I guess, if you will, and when they're looking at deals, looking at sponsors, looking at properties, or even looking at their business model, like what have you learned as to be, really important to like your success?
Well, I would say one of the things that I would really ask as far as a question, I would ask how they have performed regarding their distributions.
Yeah.
And I would ask if they have had a capital call within their portfolio.
Yeah.
Years ago, that would not have crossed my mind because it had not been part of my experience in my portfolio. So that's certainly one of the things. I would also ask about the experience of the sponsor. Not only what have they done within the multifamily space, but what was their life before? Because it gives you clues into what are the cross skills that they bring and that they can lean on and they can utilize as a sponsor in multifamily.
That's an interesting, that's one I hadn't thought of. Like what's in their tool belt already?
Yeah, I always ask what's in the tool belt.
Yeah.
And then one of the things that I will always ask is, why are they so excited about their current project?
Yeah.
You can learn a whole lot with that open-ended question as far as their property manager, what they think it's going to bring, what returns. They will tell you many things because few people think to even ask that.
Yeah. 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 And it should be like, that should be, in their marketing materials, they should be leading with that. They should be leading their webinars with that. Really anything they bring to you about the property, the deal level should be, in my opinion, like those should be bullet points, highlights, like, why you want to invest in this deal. Right. And if those aren't there and aren't obvious, and to me, if you almost have to get to the point of asking them like that would almost make me kind of look a little sideways at the deal to begin with.
I will say I've seen a lot of sponsors bring in a lot of marketing material from the brokers.
Okay.
Excellent material.
Yeah.
But if you ask them that question, you will get far deeper than the promotional material that the brokers have supplied them.
Yeah. Yeah. I can just say from our perspective, I've never even thought about using broker material in presenting to our investors. Of course, we're using stats and predictions and projections and certain things that we have vetted from the broker's material in terms of business plan, looking forward, like how to best execute and how to get the highest and best value out of the property. A good broker will have their heads around that, but that material is made for the buyer, not really for the passive investor, in my opinion.
Yeah. Well, and I've just seen it a lot.
Yeah. It's interesting. That's interesting. Okay. That's surprising to me. Yeah. Yeah. But
yeah. And I will say too, kind of wrapping around my experience, I am still very high on what we locally call the Texas Triangle.
Yeah.
And for people outside of Texas, that really is Dallas, Fort Worth, Houston, and San Antonio.
Mm-hmm.
And the reason that I am is because 82% of the commerce is conducted within that corridor.
Yeah. Yeah. How does Austin calculate into that for you?
Well, it's, it's the state capital. You do have the University of Texas. Yeah. You do have some semiconductor plant coming in there.
Big tech scene, yeah.
Yeah, you've got some other economic drivers being added into Austin. However, it just doesn't have that affordability gap in Columbus.
Elephant in the room. Yeah. Yeah.
That's what gets you you have to really move out of the city limits. And there are a lot of areas of Austin that are historic minority areas that are experiencing regentrification, and people are being pushed out of the city limits that have been 2, 3, 4 generations living there.
Yeah, you see those bumper stickers that say keep Austin weird, and
yes.
Yes.
And I've eaten at Kirby Lane, so I know what it's about. That's that whole Boston weird stuff going. Well, Denton, my local hometown, it kind of has its own weird element too. It's the college town. It has 2 universities, so it's got its own weirdness that it does bring to the table.
Yeah. All right. Well, as promised, let's just quickly kind of jump into, I just got to ask you, like, why the heck are you looking at becoming a GP? You've got all this experience as an LP. You've got that game nailed. You're well networked. All the good sponsors, how to stay away from the bad sponsors, et cetera, et cetera. What do you see in the GP game that's appealing to you?
Well, what I see in the GP game that's appealing to me is something similar that I did in single family when I had private lenders. I can bring people on, and they can increase their wealth. And what I have done in multifamily is increase my wealth to a point. It's multi-generational wealth.
Yeah,
we're starting yet another LLC, passive LLC, because I have more than one that I'm doing this through. And our daughter will be a partner in that. So she is the next generation. She's gone to meetups. She's gone to Brad Sumrock events. She's gone to AIMNACON. She's had our photo in front with Robert Kiyosaki. She even got him to have a separate photo with her.
Cool. Yeah.
Because she wanted her own, not just the family one. Right. So she's been around.
How old is she, Sharon?
She's 27. So it's a good age for her to be a partner.
Yeah.
She's got her own life in Washington, D.C., but she knows that you can have more than one stream of income, and you can make some money as a passive investor. And that adds to your wealth building, and it adds to your security. And she's also got a curious mind because she was the double major, international studies, the University of Denver, and economics. Cool. So like her mom, I have my MBA, Dan has his MBA. We all love our numbers. Yeah. And we see what those bring to the table. And honestly, because I'm so active in more than one community, I can flush out a lot of information still for her. So it's not like I've totally got my toe out of the passive side of things. I just want to explore the general partner side of things. And since my dad was a construction subcontractor, I was a construction brat. So I've always worked with contractors. And I just think I can bring people into passive investing and just really support them in their wealth building journey. I just feel passionate about that.
Yeah, and I don't doubt your ability there. I mean, you've learned so much. I mean, first of all, Brad's a lead sponsor, GP. That's usually who works with Brad, pretty much, right? Or mostly active on the active side.
Yes, some people do. Yeah, he's always GP.
So. Yeah. So I mean, so you started learning right off the bat from from somebody that is on. So and so I'm sure that you have what it takes. And there's not a doubt in my mind. I mean, it just 18 deals and working with sponsors and seeing all these deals and the nuances and everything else. But I guess the one other question that I'm inspired to ask, just based on your ability to bring other people in, like you've talked about, and help them build generational wealth, is did you ever look, or are you looking at a fund model? Starting.
I have not to date. I know that's discussed quite a bit in Raise Masters.
Yeah.
So I have not explored that yet because, well, one reason I wanted to experience the other side, the GP side, and see how that worked. But I am certainly around many people in Raise Masters that I can pick their brain regarding funds And
Yeah.
I'm certainly going to be doing that in October when we're all in San Diego.
Yeah. So the Raise Masters retreat, right? The members only retreat. I was there in last October in New Orleans, and, listeners, you probably heard Raise Masters mention, 20 plus episodes of this podcast with many, many guests directly from Raise Masters. That's how Sharon and I connected. And, just Google it, Raise Masters, Hunter Thompson, check it out. We're no official affiliation beyond membership, but we love it. And I can't really say enough good things about it. And that's totally authentic. And I have nothing to gain by saying that other than, hopefully adding a lot of value to you. 400 pretty high level, if not very high level capital raisers in that group on one Slack channel and one conversation, and a lot of times on one meeting, or like the October event all together in person. It's the power of the mastermind, and there's pros and cons to the size of that mastermind, right? But the pros are very, very compelling in my opinion. So I'm really excited for you that you guys got into Raise Masters. I think that's an awesome place for you to have kind of branched into from where you are right now. So, and I'd say this, like, all of the things that you spoke to about why go on the GP route, it looks good and appealing to you. I think could almost directly speak to why go the fund to fund route as well. And again, we listeners, we don't have time to get into what that exactly means, but essentially you're syndicating, instead of syndicating a bunch of investors, passive investors into a single deal or a single property opportunity, you're syndicating into a fund. And then that fund goes out and invests in usually multiple properties, usually in one asset class, often with different sponsors to diversify. It's another way of playing this game. And people like you, Sharon, who have the savvy, very, very, deep dive, nuanced level of experience that you have, are like, make great fund managers. So maybe just, so you're already onto it. You've already heard about it, and it sounds like you're already somewhat interested, but could be a really interesting avenue for you. So
it could be another avenue for me. And I've pivoted before, and I will say, talking to investors, I feel like I kind of have some natural ability to do that.
Yeah.
And a combination with that and my MBA, which my coursework was in finance and accounting, a lot of that. So I can really talk to a lot of numbers, and that may be a path that I eventually move forward in.
Yeah. Cool. Awesome, Sharon. Well, this has been a great hour of discussion. It flew by for me. I'm guessing it did for you too. And I feel like there's a whole bunch of stuff that we could have gotten into that we weren't able to, but hopefully for you listeners, we hit on some really key stuff, right? And, looking at some of the ugly aspects of what's going on right now with capital calls and deals that aren't performing and aren't paying prefs, and what that means, and that's even with a good sponsor, with a deal that has been, established and been around for 8 years or whatever, the 8-year hold. Like there's problems across the whole industry. And the episode I did recently with Neil Bawa, we got into whether or not this really is a distressed market, right? And that's a whole different conversation. And if we had time, Sharon, I'd get your thoughts on that. But I guess I'll cut to the chase real quickly on that, which is, Neil's point is that when you look across the totality of let's just take multifamily, the multifamily inventory in this country, right? The total number of multifamily properties versus the number of multifamily properties that are distressed, like the one you're in right now with the capital call, it's about 2%, right? Which is a lot more than it normally is. So, that's why it's getting people's attention and why people are concerned and talking about it a lot, right? But the flip side of that is we've got about a 25% market discount right now. So, unless you're buying on a rapid upswing, like say in 2020, 2021, 22, like when you don't know if you're at the top ever. So you're essentially kind of gambling, not gambling, but it's a toss up, right? Well, you could be at the tip top of the market, or you could have another couple of years of appreciation or rapid appreciation. So you could argue that was the time to buy, right? But now you've got a data supported, dip in the market that is, very clear to see if you're looking at it. And so, if you're finding deals, especially with assumable debt, with the low interest rate, like if you're getting around that particular piece, especially, it's a pretty daggone good buying opportunity from, a lot of like Neil, again, the mad scientist of multifamily, Neil Bawa, that's his thought. And that was my thought before he and I got our heads together. And I guess let's kind of sign off with that, Sharon. Do you see that in the market right now?
I'm not quite seeing it yet.
Okay.
One of the sponsors that I talked to just today said that he's seeing some things that are going to be moving forward through the banks on the note side of things. And are you seeing that, Tate?
No, I'm not seeing stuff coming out of banks right now at all.
Okay.
Yeah.
He's saying that there is some discussion.
Yeah. Sure.
Coming out of banks right now.
Well, I'm sure that's going to, I mean, that's got to happen, right? Like you just look at the sheer volume of short-term debt bridge largely that's maturing, and it's huge. So, I mean, it's got, banks don't, and the last thing a bank wants to do is take over a property or take it back. So I would think whoever you spoke to there is probably right on the money, and we probably are going to see some of that. But for listeners,
I'm not seeing it yet. I'm not seeing it yet as far as touring properties and looking for what our GP team would underwrite.
Okay,
I'm not seeing enough discount from the seller side to the buyer yet. I'm not seeing that, and our team is not seing that.
Yeah. Do you think that's a DFW specific phenomenon? Because it's so hot, right? Like it's almost its own beast.
It is hot, but I am hearing some of that even in some secondary markets in Texas, that there is still a gap between what the seller's price point is and what the buyer's price point is. So I'm seeing it, and I'm hearing of it in secondary markets as well.
Yeah. Yeah. Awesome. Sharon, we'll kind of close it up with this. And you may have already spoken to this at a few different levels, but where's the juice in this for you? Like, what is really, really, really fun about this business for you? Like, where do you just geek out?
Well, I will say there's a lot of people interaction, but there's a lot of numbers, and there's a lot of technology, and there are numbers that are separate from anything you would experience, anything else like retail, whatever. Yeah. So part of that appeals to me going way back, because my first job coming out of college was because of a friend in the oil and gas business.
Okay.
And so I got my first job out of school with Arco Oil and Gas, working in downtown Dallas.
Yeah.
That's why Daniel Nichols and I, when I was on his podcast and on and before, we were geeking out over oil, because it has its own ledgers. It has its own, jargon.
Yeah.
It really does. And multifamily real estate has that too. And each of the asset classes has their own separate codes and metrics. And, so I kind of geek out over that.
Yeah. So you love the analytics, but you also love the people part, the people.
I love talking to people about their stories, because everybody's got a different story. The oil and gas stories that I heard in my first job, I had a person who was training me whose father was a landman. So he was the person shaking the hands of the farmers to get producing property leases. So that had its own little jargon about it, and its own stories, its own success. It's just kind of and I get involved in that too, because there's always some stories. While there's some challenges and there's some struggle and difficulty, there are always a lot of things that are very promising in real estate and in multifamily. And a lot of areas where you do have multiple streams of income. You just have to know how to decode it. Hang out around people who geek out over the same stuff you do, which is what makes it fun. And then you get smarter, because you're never the smartest person in the room, because you're hanging out with the smartest people in the room. So there's always space for you to grow and learn more. And I'm a lifelong learner, so I kind of geek out over that.
I love that. Yeah. There's a lot of different facets for you that like just kind of naturally line up. It sounds like that's awesome. Sharon, thank you so much for being on the Apartment Gurus with me, being my featured guest here in this episode. If people want to reach out to you and get in touch with you or learn more about you, what's the best way?
Well, they can go to my website, which is www.excalibur, EXCALIBRE, Texas.com. I do blog, and you will get a free gift as a result of filling out the contact space, the landing page. And I'm social. So Tate and I were talking about that. I'm on LinkedIn with Tate. I'm also on Facebook because of my Siemer community. And I've also got some LinkedIn friends over on Instagram too. So I'm on Instagram. So you can follow me on those platforms as well.
So we'll link ExcaliburTexas.com in the show notes, and we'll put Sharon's social media profile links in the show notes. And guys, LinkedIn, man, like my mastermind, my guys, my small, my coaching kind of small model mastermind that I lead, we've been almost exclusively LinkedIn the last few weeks. Huge opportunity. If you're not there in a big way right now, there's it's a missed opportunity, and there's a competitive disadvantage. On the other hand, if you're killing it there, that's where it's happening in a big way. So everybody
should be on LinkedIn. 100%. I didn't at first I was like, oh no, here with Raise Masters, I got to be on another platform. And then I've continued to build a network and a community, and they're like so smart. They know a lot of different things, and so many of them have a newsletter. So there you go. You got people. You got a lot of people who have a newsletter that teach you so much for you just being on LinkedIn.
Yeah, and the reach conversation, like the huge reach that you can establish so quickly on LinkedIn. Like you said, the quality of content. It just 1 billion people, 58 million companies. So. Awesome stuff, Sharon. Thank you so much. Thank you, listeners. And I hope you got a ton out of this one. I love bringing guests like Sharon to you guys and getting her level of expertise. And you can only get it from people like Sharon, that kind of wisdom and knowledge and hard lessons learned and, everything else. So appreciate you guys, and we'll see you on the next episode. Take care, everybody.
Bye.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.